Hello and welcome to CISI TV. My name is George Littlejohn and I'm particularly delighted to be able for once to bring out that much overused word important for one of our programs, for this one truly is. We report here on the results of a genuinely major survey of wealth management amongst both mass affluent and high net worth people globally, more than 1,500 of them. It was conducted for Refinitiv, part of London Stock Exchange Group, from which we as an institute sprang 30 years ago. And here to present the research, we're delighted to have Sune Mortensen. Sune is EMEA Head of Wealth Management at Refinitiv. In this role, he's focused on the end-to-end wealth management business strategy in this time zone. And before London Stock Exchange, Sune held senior leadership roles, amongst others, at Danske Bank and BlackRock. And he has over 20 years of experience in the wealth and asset management industries during a time of rapid change, and he's a recognized and sought after industry speaker and often quoted in industry publications. So we are delighted and honored to have Sune here. Thank you for joining us. And we're also joined by two great panelists from our institute ranks. Kate Capocci joined Smith & Williamson in 2015. She is responsible investment lead for Tilney Smith & Williamson and deputy fund manager for the Tilney Sustainable Active Portfolios and Sustainable Managed Portfolio Service, as well as being manager for Bespoke Sustainable Investment Portfolios, a busy young woman. Kate was a co-founder of the S&W Stewardship and Responsible Investment Group and was a member of the Charities and Corporate Responsibility Committee. And she has a key role in the integration of ESG factors into the group investment process, and she spearheads the firm's growing capabilities in responsible investment. We're also joined by Hamish Warnock. Welcome, Hamish. Hamish works at Seckle, a custodian and investment technology provider aiming to rebuild the infrastructure of investments and advice. In his role as partner launch lead, he and his team help advisors, discretionary fund managers, consolidators, and early-stage fintechs set up and run their own investment platforms on top of Seckle's open API technology, and we'll be discussing API extensively in this program. Hamish is passionate about the role technology can take in shaping the wealth management landscape and brings that to the fore in his role as chairman of our Wealth Management Forum here at the Institute, and he has spoken at many of our events in the past. Thank you all for joining us. Sune, special welcome to you.
Well, and thank you first of all for the invitation. And then I would say, I've worked in wealth management for over 20 years, and we've always been talking about the wealth industry being in change. What is really exciting now is that the pandemics has sort of accelerated change, but it has just altered the way we see on things. So what we thought was digitalization once is just completely different. So I mean, the buzzword right now is hyper-personalization. And how can we bring that to customers in a time where we all have to be very cost conscious? I mean, that's very, very exciting.
Sune, thank you very much. You've seen a great deal of change just in the past 20 years in our sector. Please tell us about the results of the research. And thank you again for joining us.
Thank you so much. And yes, indeed, we've been working on a presentation here where we have asked a number of customers throughout the world on what future really looks like within the wealth industry. Basically, because we want to learn more about how to attract and retain modern investors. For us in London Stock Exchange Group, it's really exciting because we live to enable wealth managers out there to bring that service. Hence, we need to know something in order for us to partner with our companies. And so without further ado, let's dive into it. So the exciting thing about a presentation and obviously the survey like this is getting more insights from actual wealth management customers on how they want to be, approached and how the wealth managers can attract and retain these modern investors. We all know there is a difference in preferences between young and old clients, but how does it really materialize out there? That is what I will deep dive into in just about a second. But before we do it, and before I give you the background for the presentation a little bit further, I think I would like to share some of the points I hear over and over again when we have senior conversations throughout EMEA with wealth managers, because that is the current situation they're in. So first of all, what I hear out there is that most wealth managers, they're actually struggling to find the right data or actually just use the rich data they already have at hand. Remember, many wealth managers and banks, they actually have more data, more knowledge about customers than Amazon or Google or Facebook. They're just not able to retrieve it because it's not sorted right. So we often end up having data discussions how to use it, how to structure it, and then how to apply it. Second, wealth management is more about investment. It is about bringing financial well-being to the customers. And so the aspect of advice is much more holistic, and it's much broader than just portfolio construction. And what I hear is that that concept of risk is getting more and more nebulous. And what do I mean about that? Well, from a customer perspective, as I will show you shortly, they are taking in information from many more sources now than they did beforehand. And when it comes to portfolio construction, they're expecting you to include many more factors than just the old school fixed income and equities. Hence, it's getting harder to be advised out there. And the requirements, not only for the technology you use, but also your ability to explain it is really getting so much more complex. Third, I mean, everyone is talking about digitalization, and when we have senior meetings with decision makers, they are presenting us for new business concepts, and everyone is talking about digital first. But what I see mostly is that many wealth managers are trying to create a digital version of their old self, and that's just a mistake, because people are not benchmarking their wealth manager with the wealth manager next door. They're benchmarking their wealth manager with an online shopping experience when they're buying wine, or shoe, or perhaps even a car. And so as wealth manager, you have to orient yourself more broadly, and you have to realize that the future customer experience does not look like the one they had yesterday at all. And then fourth, margin pressure here in the region. It's still relentless. And you know why pick up such a boring comment here? Well, digitalization, that requires investments. So how is it you make the correct investments that will actually be investments with a yield and not just additional cost? And when you have to invest a lot of money in a digital experience, should you actually divest parts of your business? Are there things there that does not even contribute to differentiation anymore? So all of a sudden, these conversations are getting quite complex, and it takes a lot, actually. So that's the current picture. Moving into the survey, just a short background. So obviously, some of the opinions I will present here will be formed on what I hear out there talking to decision makers, but it will primarily be based on this new global survey we've made. It's among 1,500 respondents, and what we tried to do is to get a, let's say, a glimpse into the future. What is it that customers are asking for, both in terms of products and services, but also it's very interesting for us to sort of figure out, are there big discrepancies between millennials and older clients like myself? Because you need to cater for a transition of your service from the, let's say, the current or the older segment to the future customers going out there. And how is it you do that? So that's just the backdrop of the survey. The first finding I would like to share with you is basically on where do people find reliable sources of information. And if you look upon the left hand of the screen, most reliable source of information, that is, those are the sources among all the respondents. And what you will see is that almost half will say that the advisor or broker is the most reliable source of information. And if you skim down the bar chart, you will figure out that newsletters, magazines, industry data, so on and so forth, classical pieces of information are deemed more reliable. What is interesting then is that if we carve out the millennials and look on the right hand of the screen, well, the advisor still pops out as the most reliable source, not as significant as when you ask the total population, but what is interesting is that what comes next. That's not newspapers anymore or traditional media. It's SoMe, it is YouTube, it is gut instincts and webinars like this. And it's just a completely new source of information. The reason why I bring forward this, let's say, all this new stuff, these new sources of information among the future customers for wealth management is that for a wealth manager today, you just need to be present on social media. Not only to position yourself so they can form an opinion and sort of almost be, have affection for you through these media. But you also need to be present in order for you to scan what are current trends, what is the sentiment, because if this is where they form opinions from, if these sources are deemed reliable, which they are, so it's not a critique, but then you need to understand what's going on. So when you have a millennial in front of you for an advice session, you are able to speak the same language and you know the trends and what sentiment is going on. And that is why it's so extremely important, not just to do advertising in the airport in Geneva, these classical places for wealth managers, or London City Airport for that matter, but you need to be much more omnipresent, and you need to respect the new medias just as much as you respect Financial Times and more classical sources of information. And I think this brings us to a crucial point from the survey. I will talk about hyper-personalization. And that really means that you orient your advice through the single individual, the way he or she understands it best. But what you need to respect is that clients of the future, they want to understand what is it they're buying. They want to understand the advice. You as a wealth manager are not only, you're not longer the only source for truth. They will form their opinion based on many, many more sources, but they want to understand. And therefore, they want that personalization, because then they get learning the way they learn best. Some people, they like to read. Some people like visuals. Some people like complex issues, and being presented for complex structures in order for them to understand. For others, it needs to be a little bit more simple. And you, as a wealth manager, you need to be able to figure out who's in front of you and how is it they learn, how is it they understand. The good point is that 64%, so 2/3 of the new customers, they are willing to pay more for these personalized services. So if you're able to do that, if you're able to bring hyper-personalization, you can charge for it. And back to the margin pressure, this is actually a source for revenue. Obviously, it needs to be digital, so it's scalable, it's consistent, and it's cost efficient, but then you can actually charge for it. And I think that's a very, very important learning to bring from this. If we move forward a little bit, this was how they form their opinion, what sources of information that are sort of deemed reliable here. Moving a little bit forward and look upon the investments, and that is only a part of wealth management, but still, what do they expect to be in the portfolios? What needs to be part of the advice? We get some pretty interesting learnings from the survey as well. ESG is a massive trend right now. I've been around in the wealth industry for about 20 years. For, 5-8 years ago, alternatives really picked up as a new theme. All of a sudden, not only pension funds and buy side, they needed to have illiquid alternatives as part of their portfolios. And I think many wealth managers have sort of solved that issue about illiquidity, so on and so forth. And many clients are now having some kind of alternative assets in their portfolios. The biggest theme right now is undoubtedly ESG. And what we're seeing here is that there is clearly an orientation towards ESG. There is clearly a need for it. And I will show you a little bit later how people choose a wealth manager in the future. But what is really important to understand here is that it is very, very complex. I mean, all market participants here in EMEA have seen the struggle on an EU basis to create a taxonomy. I mean, on a global scale, people are struggling to understand what is E, what is S, what is G. Does it mean the same in the US as it does here in Europe? But the important thing from the survey is that people want ESG, but they also want to understand it. So again, from a differentiation parameter, if you're that wealth manager that enable people to understand what is ESG, what effect does it have, both on the portfolio, on the yield, but also on the society as a whole? I mean, climate is the most obvious factor here. If you're that one who can differentiate itself, then you are able to attract new customers, because this is so important now. So the explanation and the personalization of ESG here will become a competitive parameter moving forward, no doubt.
Kate, thank you, Sune. Kate, you're one of the great gurus on ESG. How do you respond to what Sune has spoken about? How do you persuade customers that ESG is the way ahead?
I would completely agree with the findings here. Investors are so much more keen to have a better understanding of what ESG is, but also to make sure it's being done in their portfolios. I think one of the big barriers here, and one thing that the EU is trying to get around, is there's no standard definition to what this means, and to a huge extent, ESG does mean different things to different people. Some people are willing to hold oil stocks if they're engaging, and some people divest entirely. There are shades of grey that are really hard to marry off. So I think it's really important that, you know, as wealth managers, we're just very clear at explaining what different products are and kind of how they can be adapted for different clients, because, you know, there's such a range out there and they're all labeled in a myriad of ways, in ways that are vastly confusing even for us as professionals. And so it's our job to try and tear that down and build something for our clients that they can understand.
It looked at from an industry perspective. When Mark Carney was speaking a couple of years ago, in the run-up to COP26 in his new role, post-Bank of England as climate envoy at the UN and also climate finance advisor to our Prime Minister in Britain, he spoke about the importance of every investment decision, every financial decision being made with climate in mind. And I think by climate, he also meant some of the other sustainable development goals that feed into ESG. How do you think we as a profession can get to grips with that huge challenge where there's no real playbook that works? You can't really take a playbook from existing entities and turn it into one for the climate challenge or the biodiversity challenge or the many other SDG challenges. How do you think we should cope with this? Apart from, of course, cloning people like you to make more of you.
I wish we could clone more of me. It would make me a little less tired. But no, I think what we need to do is just kind of understand it. It's a learning process. It is an evolution that we're all kind of on together. And I think it should be taken much more of an opportunity to kind of innovate new ways of doing things and think about these things in different ways, rather than trying to follow some of the old structures that we used to use. And I think it's one of those things as well, we're constantly evolving and learning. And I think one of the biggest things that is coming out of the growth of ESG investing is this need for transparency and this need to kind of just articulate very well what we're doing. And that comes from the companies all the way down to the wealth managers. We all need to be just a bit more open about where our money is going, what we're actually doing, so that we can make those choices and those decisions in the most informed way possible.
Thanks, Kate. So in new and different ways that Kate speaks about, I've been fortunate to have a peek at your research before publication, and I think that is the next step that we're coming to.
Yeah, definitely. But again, Kate's point about ESG is different to all of us. What I think of oil is not necessarily the same as what you or Kate thinks. So for a wealth manager, you have to be extremely respectful. This is definitely not a one-size-fits-all. So I think we all know ESG is a massive trend, and I think every wealth manager is struggling right now to get his or her arms around it. What we also used the survey for was to get a little bit of a glimpse into the future. And I hate to sort of let's say disappoint people or make them, you know, completely exhausted, but I started by saying change is happening ever so fast, and I mean pandemics has really accelerated a lot of things. So when we look a little bit into the future, we try to ask what do you think as a customer will be a driver for change? What is interesting is that if we look upon the population from the survey that is above 55, they are answering quite, you know, let's say conservative things like, you know, cost. It's about performance from the portfolio, and then it's something about ETFs because they are quite cost conscious. So those are classical factors. What I think is yet more interesting is to look upon what millennials thinks will carve out and sort of define the industry in the future, because now it's getting really, really modern, I should almost say. So obviously, we all heard about cryptocurrencies, and especially under the pandemics, people have taken this, and I'm actually struggling to call it an asset class, but they have taken this asset, this thing into themselves, and it has become a highly, highly popular vehicle for investments or speculation, actually. So going forward, millennials actually expect cryptocurrencies to be part of the advice, and actually many answer they expect it to be part of the portfolio. I mean, I've been in the industry for 20 years, and I remember back in the university, the long discussions you had when doing portfolio construction. Should you hedge, should you not hedge currencies? It's the same out here in the real world. Well, equity, don't hedge, fixed income, you should, so on and so forth. But cryptocurrencies is just a whole new means. It's a new animal. And so how is it you bring that in? And what is that actually for an asset class? The same goes for tokenized assets and non-fungible tokens. And I mean, the latter, the non-fungible tokens, I mean, I haven't heard of that 2 years ago. It's such a new thing, but yet 1 in 5 expected to be part of advice going forward. For me, it tells something about an industry facing a revolution, actually, and advisors and advice systems facing a revolution, because we're just adding things on top of all the traditional stuff. So complexity is just going up and up and up. So this glimpse in the future tells us there's no time to rest. We need to prepare for the future, and portfolio construction and advice will be ever more complicated. If we look a little bit into, okay, how is it we should show this to the customer? What should wealth look like going forward? When I have senior conversations, you know, the question I'm often being asked is, what does great look like? And obviously I'm able to bring an example here, an example there, but we don't have any full-fledged, you know, perfect modern wealth managers out there yet. Obviously they will come. But let's see what it is really the clients are asking for. And, you know, with one word, it's a cell phone. Basically, the let's say really, really significant answer we're getting from the survey is that people expect us to be as wealth managers where they are. They expect advice to be mobile. They expect us to be mobile first, basically. This is not to say they don't want an advisor, but it's just that this is to be seen as a new distribution channel that is being enforced even more so than what we have seen beforehand. And if you look upon these replies they're giving to the survey, there are 3 things that comes through. I think you need to respect as a wealth manager. A, you need to bring holistic advice, and that not only goes for held away assets, but it also takes, you know, home equities into account, whatever liabilities in form of mortgages, so on and so forth, dreams, wishes, whatever. So it needs to be holistic. Second, there needs to be an element of education, and I would almost add edutainment. So it needs to be in a way so people are feeling or getting involved in it, and at the same time they're learning, because as we saw in the beginning, people have a want and a need to learn and understand. And third, C, it needs to be means for communication. So it's fine you have access to overview, it's fine you'll be presented for a status or a development, but you can see here it is also means for communication. So it needs to be two-way. It could be a short text message, it could be a short video comment or stuff like that, but it needs also to be communication and not just pushing information to the customer, obviously highly personalized. I would imagine many wealth managers are sitting out there a little bit short of breath right now and figuring out how to solve this. I think the positive news here is that we're seeing technology advancing and developing so fast right now, so it's actually feasible. The greatest examples are not necessarily from the wealth industry, but more when it comes to consumer goods and leisure goods like that. I will return with an example in a second. But the rise of APIs, widgets, and that data transferability is something that can really change the market. And so I'm quite optimistic that you can solve for this, and much faster than you could in the past. But clearly mobile first, two-way communication, and it has to be really agile.
Hamish, this is very much your parish, the bringing of technology to bear on wealth management. You come from a wealth management background. Can you reflect a bit on this, please, and what Suni has just said?
Yeah, sure. Thanks, George. Look, I think firstly, I don't think it's over the top to say that the difference between success and failure within this industry and many others will be defined by technology. It is that important. And I think, again, to Sune's point, part of this and the change that we're seeing and the change that we're going to continue to see going forward is the proliferation of the API. It's the increased use of that. And it's the increasing looking at what underpins your business from a software perspective. And to that end, I think, to the question that's on one of the slides to come about how firms improve their platform experience, I think the answer to that is to really take a good look and take back control of your firm's tech stack. To just traditionally and to date still, thank you, that's the slide there. We are all as a collective using a ton of different pieces of software and tools and systems, none of which talk to each other and are held together with sticky tape and blue tack. And by taking back control of that API first technology, being agile is really going to help take a step forward into what clients are going to be demanding in the future and some of the things that Sune has been talking about. And I can't really drum home enough that idea of sort of hyper customization and personalization around what clients of the now are going to be demanding from their wealth manager and their wealth management firms. And it is super important because not only are they going to be demanding it, but going forward, a wealth manager is going to end up with more referrals that way. Customer journey is going to be much slicker. The UX around how they serve their clients is going to be much higher. And overall, your clientele is going to be much happier because when that personalization, that customization side of things, you are looking at their needs, wants, and desires to them as an individual or a group of individuals, and not catering necessarily to the masses. And technology will allow you to do that. So I think it's it can't be the importance of it can't be overlooked.
Thanks, Hamish. Can I ask you a slightly lowball question about low code and no code? You talk about sticky plaster being used to put together APIs. Do you think low code and no code, that movement will lead to better production of what our clients need, or is it too early to say?
No, I think it absolutely will. It's the point of no code or low code is that, quite rightly and understandably, wealth management firms or other firms to that end don't necessarily have the engineering or the development prowess in-house. It's all well and good to say that to integrate with an API is the way forward, but if you don't have that in-house knowledge, you're either going to be outsourcing that or you're going to have to bring it in somehow. No code, low code bridges that gap. It allows people to build systems and solutions and integrate other tools and pieces of software without having that knowledge in-house. So again, it's a massively important thing. It really will help those firms and those individuals who want to move away from legacy systems and pieces of software to really bolster their back end, which means that they can make their front end and their portals and user interfaces as slick as possible. So no, it's a really good point.
Thanks, Hamish. Suni, back to you for this great.
Thank you, and just allow me to offer a few reflections on what Hamish said. I think the positive news is that you don't have to be sort of stuck with your old tech legacy stack. I think exactly the point about APIs is that you can build on top of it. And so you have unprecedented agility and you don't have to wait like you did in the good old days. You put it on top, which is really excellent. And then let me offer, a picture almost from the world of sports. So if you look upon really successful sportsmen, like take a Nadal, right? He has 21 slams right now in tennis. It's a sport I like a lot. But Nadal is not just Nadal. He has a great team, right? He has a nutritionist. He has a physical trainer. He has a technical trainer. He has a mental trainer. He has a team. He's partnering up with people and not just great tennis players. And the same we see for successful players out there. They are partnering up. So we are not anymore seeing them, making a deal with one big company and they can be the end all be all for all their sort of wishes and goals in the future. But they set a team of UX designers, a team that can offer an analytical overlay, data team, so on and so forth. So what you're seeing going forward is that wealth managers are collaborating with teams, agile teams that can offer this. Hence, the time to market will be lower dramatically compared to the old past, where you had this almost monolithic approach of one-to-one, and you're using your own internal resources, so on and so forth. So the team and the partnership thought, I would like to advocate a little bit more for that one. Moving forward slightly here, change is about demand in the future. And the reason why you change is that you want to meet new demands. So what is it? How is it customers will choose going forward? We tried to ask a little bit about that. If you look upon what they're looking for, the older part of the survey, so the 55 and over, it is still traditional factors like fees, return. It's about ability to offer planning services, so on and so forth. Very, very traditional with management virtues. But if you look upon the future clients, the millennials, the below 35s, it's a completely different picture. Obviously, they're still interested in fees and returns, but look upon trust. Almost half of them, they want to choose somebody a friend will trust. And that goes to my original point about the show me, the way of sort of getting data, who's reliable, who's not reliable. So trust is just a main driver going forward. Cost and performance will be perceived almost as hygiene factors. It just needs to be in place in order. But trust is just super, super important. And the same goes for digital capabilities. I think we've all heard the stories about customers, young customers who have been attracted to a bank, perhaps even their parents' wealth manager. And in the beginning, they just pick and choose the same as their parents, but they don't have the same need for paneled walls, for the coffee in the majestic stateroom and all that stuff. They need digital capabilities. They are mobile first. So for all of a sudden, their parents' wealth manager can actually be turned down for something more modern, something more agile. And as we're looking into an unprecedented transfer of wealth in the forthcoming years, I would highly recommend for all wealth managers to pay attention to that, let's say, left part of the column. Digital capabilities, trust, and ESG. These three factors will be crucial to be able to meet as a wealth manager in the future. Hence, lesser emphasis on the coffee and the paneled walls, but more on the digital first and the ability to act socially responsible as a wealth manager out there. That will be a make or break going forward. That brings us into the conclusion. And first of all, before I sort of mention the specific conclusion here, I would say that the landscape is changing very, very fast. I started by alluding a little bit to the fact that wealth managers will no longer be compared just to the wealth manager next door. It will be compared to all digital experiences that the customers are having, all buying experiences actually. And why is it I need to have a so much better experience buying a book or a bottle of wine online than when I'm getting my wealth advice? When buying books or red wine, whatever, I'm being presented with what I want to see, with the grape I like to drink, and I'm not being presented by all the other stuff. They are actually so smart now, they can also present the bottle they think there's a very high likelihood of me buying. And the same goes when I'm buying tennis equipment, the next racket, the next best conversation, or the next best action. This is what we have to orient ourselves towards as wealth managers. And these are the benchmarks we will be held up against. So the landscape is changing, and it is changing very, very fast. The current and the future customers, they are looking for a different experience than what they have had in the past years. And what I would say is that to be able to attract, to be able to understand, and to advise these current and future clients, you need access to, an understanding of, and the ability to show much, much richer data than what you have ever used before. including social media, including sentiments, trends, and not just, volatility or standard deviation on a portfolio. The concept is so much wider and more complex, hence, so should the data pool be. But you need to sort it out. You need to personalize it so people get it, so you don't drown them in information, basically. It needs to be relevant. Second, when trying to understand the customer and revealing their preferences, the portfolios are much more complicated than before, because such things as cryptocurrencies, non-fungible assets, tokens, so on and so forth, are slowly popping up now. That complicates things even further. So your ability to present the right offerings at the right point in time is just, again, crucial. And I think we all know wealth is much, much broader than just portfolio advice. It's also advice on life, on tax, on pensioning. And with a life not as linear as what I used to know, or perhaps you used to know, John, but with a life that is more marked by gig economy, consultancy jobs here and there, but people actually making a lot of money on that, you need to be able to bring advice on a more complex total portfolio people has, a different way of life, basically. When you bring that advice, I mean, when I've worked with managers throughout the years, we've always talked about these advisor journeys. So a journey starting with you want to reach out to a customer, all the way over preparation and a meeting and signing of a new contract. Well, that journey or that workflow has just changed dramatically. You need to think of this as omnichannel. A lot of stuff will actually happen in parallel. You might have a system as advisor you're working in, but in parallel to that, you're communicating with the client on text messaging or video snaps, whatever, at the same time. And the way you're contracting might be completely different from before. So you have to prepare for that omni-channel workflow. And what is absolutely crucial here is that when we talk about hyper-personalization, the experience the customer is getting, whether it's from a phone or an iPad or a computer, or actually an old school, old-fashioned face-to-face meeting, it needs to be a consistent customer experience. Because if it's not as consistent as the customer expects, they are not forging a strong relation to you. And they will be strongly disappointed after a great one-to-one meeting that you cannot offer a mobile app, or vice versa, because they're expecting both, actually. And so that leads me to the last point I have. So when you look upon the literature of economics, and basically that's what wealth managers have studied, it's about rationality, about people taking rational decisions. They are able to weigh risk and performance, all that stuff, risk, reward. But the human being is not a rational being. They take irrational decisions. They succumb to trends and new themes and new ideas that pops up and comes in. And so as a wealth manager, you cannot longer assume people are rational and taking rational decisions. You have to be much richer than that. You have to lean more into that new school of behavioral economics that is really, really getting more and more traction right now among wealth managers. So you need to bring advice differently in a form and shape so people get it because they want to understand it. If they understand it, you can actually differentiate yourself and you can charge for it. And that is what great looks like. Hyper-personalized, but profitable wealth management going on in the future. Thank you.
Tony, thank you. That was absolutely brilliant. Can I ask Kate and Hamish about this omni-channel opportunity and potential problem? Kate, first of all, which is that sometimes I think that someone in your position must feel a bit like a doctor, with someone like me turning up, having looked up things on the internet and saying, I've got typhoid, and the doctor says, no, you've got a sore foot. Do you find clients who find an awful lot of information about ESG in particular, as I probably do on the internet, who turn up and give you the wrong sort of advice to give to them?
You definitely hear a lot of different things that investors have found in the media on ESG. I think it's unfortunately one of those areas where we're currently in that little tricky line between doing the right thing and accidentally greenwashing and somewhere in between. As we all know, the press love to sell newspapers and saying that XYZ investor is a greenwasher because they hold this. is, fantastic, and you'll have those articles and clients coming to you and they're like, why is this in my portfolio? Apparently, you're greenwashing, or this company is greenwashing. And I think in some cases that is true. In other cases, it is a very complex area. And as we said earlier, with a lot of gray areas and nuances as to what it means for each person. So trying to explain that, you can hold certain companies and still be a responsible investor, and trying to explain that to a client and ensure that they understand it's not so much about potentially individual holdings, but how an investor has got to holding those stocks. So that's the kind of thing you'll see a lot of people finding information in the press and getting all very excited about it. And additionally, things like divestment from fossil fuels, or kind of protest or active investing, and some of it is very valid and we can speak about, but yeah, you get a full range.
Thanks, Kate. I'm going to ask Suni in a minute sort of questions that he would like to ask these two practitioners here. But Hamish, can I ask you, you spoke about the stack earlier, this positioning of any organization from the machine language at the very bottom to the user interface at the top. You're in a relatively smaller, very nimble and agile firm. Can some of the big players out there, many of the people from the firms employed watching this program, can they be as nimble as you can be in this new world?
Yeah, 100%. I don't think I would be sitting in my chair at Seckle if I didn't believe that. So yeah, I think the key thing is that the technology that we provide allows firms of all sizes, be it early stage startups, fintechs, through to large advisors and PE-backed consolidators, to be able to set up their own and operate their own investment platform. That is very much the ethos at the core. So it is about, unfortunately for the platform world, cutting out that middleman and becoming the platform in your own right. So yeah, 100% the answer to that is yes, they can. And with that comes custody and various other bits which we're not talking about today. But the point, I think, is that the firm has to understand what they want from their platform, what they want to remove from their current world, and what they want to improve on a going forward basis. It is absolutely about cutting out legacy systems. It's about being quick. It's about things talking to each other. It's about being able to pull all of your clients' information into one place. If we go on the presentation, there was one of those charts was having a dashboard of your assets was the most important thing for underlying clients. And it's an area that the industry is not particularly good at the moment, isn't it? But the API allows that, and that will be everything from assets that you hold on your own platform or a particular platform. It may be multiple platforms. It may be alternative assets like these NFTs and cryptocurrencies that are difficult to hold in retail portfolios at the moment. It may be, in times to come, it may be everything from your financial planning, your estates, your solicitor stuff, your accountancy side of things. This is everything that touches a wealth management client, and an API allows you to do that. So yes, the long and short of it is you don't have to be small. Actually, it spans the whole spectrum of the wealth management market, George. Thanks,
Hamish. Suni, your researchers did a great job researching more than 1,500 high net worth individuals, mass affluent people around the world, and I think in about 30 countries. What would you ask these two seasoned professionals here, young but seasoned professionals, to guide your way forward?
Well, I think I would like to start to ask Kate about the ESG part, because what we are seeing right now is ESG is really climate, right? It's easy for the wealth managers because you can sort of put two lines under it, results, so on and so forth. What do you think will happen forward? Will the S, so the societal or the governmental factors, will they actually get a little bit more traction? And how should wealth managers be aware of that?
I think that's quite an interesting one. I think S is definitely the left out lonely child. I think governance, to a certain extent, has been subsumed as part of just general investment management. I think since the financial crisis and all the main changes they made after that on a regulatory basis, governance has almost already become just part of how we invest. I think, you know, environmental at the moment is, first of all, it's like a big global crisis that we can all kind of pull into, and we're all acting together. And secondly, it's a lot more measurable. Like, you can measure your emissions of certain greenhouse gases, and you can show your performance. When it comes to social factors, it's a lot harder to show kind of how good your labor management is and how that's been improving. And you know, those kind of factors are a lot more qualitative when you get that information, and it's harder to show the same kind of direct cause and effect on kind of what you've done to improve that, and how that has improved that particular factor, and how that's improving company performance. So I think it's going to become one of those things that is getting more important, but it's more difficult because it's harder to quantify easily, and it's harder to report and measure in the same way as some of the environmental trends.
Thank you. The next question could be for Hamish. I think it's interesting because I think you're right, especially APIs will be a game changer going forward in terms of agility and the way to be innovative going forward. But how do you see the following? Because looking back, I see many wealth management companies being very conservative. They're used to working with few, very big, very established tech companies, data vendors, so on and so forth. And now they have to look for a team of smaller players, definitely younger players, more agile, with a completely different background and culture. How do you see that playing out? Are they comfortable setting such a team with people that are, and this is diversity really where it brings value, but are they willing to sort of be diverse when it matters, so to speak?
Yeah, I think it's the classic snowball effect to a degree, isn't it? We are seeing that more and more firms are looking towards that and actually actively coming away from some of the larger players, because they can be more involved in the agility, into the development roadmap, into how quickly things are rolled out, shaping what the tech provider does, and therefore their business on a going forward basis. They have more power, you know, classic sort of not a small cog in a large machine side of things. So, but of course comes confidence, and you've got to have a run rate in order to be able to show that. So, you know, I think we and other firms are starting to see that now, and more firms are sort of becoming interested in using the technology in order to go forward to build their own platforms and become inclusive in using technology. But it's always you know, there's that sort of tipping point, which I think we'll see in the not too distant future. And I think the fact is that you know, you are right when you were talking about in your presentation about what's going to drive this, and I think we can't underestimate that great wealth transfer down to the underlying clients' sons, daughters, grandchildren, and technology is going to facilitate that. So I think it's really at the back of a lot of wealth managers' minds at the moment, and which direction they take will be driven a lot by the knowledge that the wealth is going to go down to those that will want to embrace technology.
Thanks, Hamish, and thanks, Kate. I'm afraid we're running out of time here, but before we come to any concluding remarks, going to come to Hamish first, then Kate, then Sune. The full research report is available on the website where you're watching this on CISI TV. Please do read it. It's absolutely fascinating. We hope to welcome all three of you back on our screens again very soon. But Hamish, any concluding remarks from this wonderful session?
Yeah, thank you. Firstly, it's been really good. I would just reiterate hopefully what we've all been putting across from a technology standpoint, not to underestimate it in any way. It is here to stay. Technology and fintech is here to stay. To give you a closing stat, last year, a quarter of all the money invested in fintech globally, a quarter of that was in the UK alone, £1 in every 4. So embracing it now is going to be very key in order to go forward. I think there will be attrition for those firms that do not keep up with the curve in the technology side of things. And one thing we haven't really touched on, it's a bit late at the moment, I think is really key that not many have cracked really at the moment, if any, is that idea of the advice gap. And that's something that should be at the forefront of all of our minds, is democratizing the world of investments and finance and opening up to the masses. and that will not be possible without embracing technology. So that's my closing statement, George.
Thanks, Hamish. Kate?
Yeah, I would say we've already spoken a little bit about that huge transfer of wealth, and we know that up and coming younger investors are far more interested in ESG investing. There's a huge risk here that, opportunity cost if you're not able to offer something that these younger clients want, and also you're putting yourself at there for regulatory risk. We're already seeing in the EU sustainability preferences are about to become into law. We're going to see something similar in the UK in the future, in the not so distant future. So it's very much get ahead of this now for your clients.
Kate, thank you very much. And last but far from least, Suni.
Yeah, thanks again for the invitation. It has really been a pleasure. I think I would say change is happening really, really fast, and even digitalization is not what it used to be. So as a wealth manager out there, you really have to take it very, very seriously, and you have to respect that your peers are not anymore the wealth manager next door, but all the other places where people are getting advice digitally. And that can be from online shopping of groceries, books, whatever. But the benchmark is just different right now. So you have to orient yourself, you have to listen and learn, but also be aware there are solutions out there. So get out there and get them.
Suni and all, thank you very much indeed. Thank you all for watching. There are some great issues here to which we must return on CISI TV in the near future, particularly the advice gap, which is increasingly important. The research, as I said, is available on my CISI right beside the video, which you're watching this right now. And we hope to see you all again very soon. Thank you.